Hello and welcome to our quarterly Talking Property series, The House View. Together, CBRE's Australia and New Zealand CEO Phil Rowland and Head of Research Sameer Chopra investigate what's next for the Australian property sector, the potential disruptors, emerging opportunities, and what's top of mind for the industry's major players. We hope you enjoy their conversation.
Hello, I'm Phil Rowland, and it is great to be back with Sameer Chopra for our first edition of the House View for 2026. In this episode, we'll be exploring our outlook for the year ahead. Sameer and his team have just published our 2026 Market Outlook Report, which has very interesting themes for the Australian property market. The most notable being this era of constrained supply, something Sameer has identified as TINA. There is no alternative, so we'll get him to explain that acronym for us and discuss its expected impact on rental growth and returns. We'll also take a look at what's on the horizon for the various asset classes, contrasting Australia with other global markets, and be sure to stick around until the end of the podcast to hear our predictions for the year ahead, including why developers should be building now. Before we dive into it, Sameer, you travelled to India over the break to visit family. The India economy is on a real tear at the moment. What did you pick up while you were there?
Yeah, Phil, India's definitely on a tear. A lot of infrastructure investment going on in India. Office rents, particularly in markets like BKC, are up sort of 20% plus. So there's this vibrancy about India, but the kids really enjoyed catching up with their grandparents in India. That was definitely an experience.
That's the most important part.
Yeah, that's right. And look, on a personal level, Phil, as you know, November, December last year, I took up Pilates. Yeah. So I've kind of continued to do that. It's a real sort of focus on trying to build my core strength.
There you go. Oh, well, I'm sure you'll be in Zen mode.
Yep.
Right, well, let's get down to business. Let's start with what we see on the horizon as we kick off the year. Our global teams have produced a range of country and region-wide 26 outlooks. And it's fair to say that despite all these prevailing geopolitical tensions, sentiment's positive, and there's a real sense that we're entering a new cycle in commercial property. We're seeing some common themes across countries, such as a recovery in transaction volumes, the scarcity of new supply, which I'm sure we'll get into, and the ongoing outperformance of premium properties, particularly in the office sector. Sameer, let's start with investment volumes. What are we expecting?
Yeah, Phil, look, last year ended well, and just looking at transaction activity, we're expecting 5 to 10% growth for Australia and New Zealand this year. Our colleagues in the US are looking for about 16% growth. But I think, we've just seen some good conviction coming back around asset pricing now. Last year, we saw 10 to 20 bips of cap rate compression in shopping centres, about 30 bips of tightening in Sydney industrial. So, you can sort of start buying or selling with some level of conviction now that prices are stable.
Yeah, you can certainly see that. And I think the swing factors between an okay and a great year will boil down to a couple of factors. Firstly, if we have a period of broadly stable interest rates, and we'll see what transpires there. And secondly, investor interest broadening outside of Sydney and Brisbane to encompass Adelaide, Melbourne and Perth.
Yeah, Phil, and outside of just transactions, leasing itself, we're expecting mid-single-digit type volume growth. Our expectation is that larger occupiers will start to come back to the market. They'll start to bring forward their decisions. But on the flip side, the one other thing we keep talking about is the downside in leasing at some point as supply starts to fall, right? You'll just have a lot fewer relocation options. And so, over time, leasing velocity could slow down, particularly if we have a large hole in supply.
Yeah. Well, we definitely saw occupiers bringing forward decisions in the second half of 2025. We saw meaningful acceleration in leasing activity. And the fourth quarter was particularly notable for office. And we saw this come through the most in Brisbane and Sydney. So the market seems to have picked up on the message that we're going to see much lower new supply through to the end of the decade. So occupiers are certainly looking to get themselves set.
Yeah, look, supply numbers for office, shopping centres and hotels will be down 40 to 50% over the next 5 years compared to the last 10 years. So down, call it half. And in industrial and residential, supply will be down 20 to 25% in the next 5 years compared to kind of what had been done in the last 10 years. It'll just get tighter. There'll be a lot fewer alternatives for occupiers and tenants. And hence, Phil, we've used this new tagline of TINA, T-I-N-A, which stands for, there is no alternative. It's a nice way to kind of think about how acute conditions get as we enter this sort of supply drought at the end of the decade, with much lower vacancy.
Yeah, and coming at a time while things are broadly pretty good from a macro standpoint. We've got the Australian economy, will continue to grow. We'll see 2% GDP growth this year. Immigration is still an important factor of the growth story. 280,000 new immigrants to Australia, healthy employment. So, Sameer, when you sort of zoom out a little bit, what are your biggest bets or your best bets for 2026?
Yeah, look, we are forecasting 10% per annum total returns for the majority of real estate for the next 3 years. I think it's a good patch. And this is mainly a result of income yield or rent growth. Unlike commercial real estate, in apartments, capital growth is the biggest driver of returns. So in terms of, what we're most bullish on from a returns perspective, we like office in Brisbane and Canberra. I think that'll outperform the rest. Industrial in Adelaide and Brisbane should outperform. And then shopping centres in Sydney and Melbourne. And then, we continue to like apartments on the Gold Coast and in Perth.
Okay, that's a good list. So, look, from the conversations you and I have been having, Sameer, you certainly expect office could outperform other sectors. But more importantly, performance is also increasingly location-centric, with Sydney and Brisbane leading in those early stages.
Yeah, look, the prime, well-located office should do well, Phil. But to be fair, right, valuations for office also compressed the most. They were down 25 to 30% over the last 3 years. So you're coming off a low base. Mm-hmm. And most recently, right, we've seen effective rents for prime office in Brisbane, CBD, Canberra, CBD, Sydney, CBD core, growing at 7% last year. So you've had really good rental growth. Valuations were really, had come off a lot. So I think it's a good setup.
And this strength in rents for prime offices, particularly in global gateway cities, is becoming more and more evident. I think Tokyo posted 13% year-over-year growth. Our colleagues in the UK recorded 9% growth for prime office in London core and 19% for prime West End.
Wow.
It's remarkable. And in the US, I suppose the story is not a new one, but the coastal cities like Boston, San Francisco, Manhattan, they're seeing 20 to 30% uptick in leasing volumes in the fourth quarter. So I would agree with you that well-located office could be set up for a very strong period of performance. But we also need to continually be mindful that rent growth in the office sector is very bifurcated.
Yeah, it's a have and have-nots type of situation. Yeah. And our messaging on Australian office is also that in 4 of the next 5 years, most of the major Australian CBDs will see no new supply. So, choice is going to become harder. This is that TINA concept. Yeah. And for some occupiers, the next best option might become your only option, your only alternative.
So let's move forward a little bit. Supply might be restricted in office, but for now, logistics has seen healthy supply levels, and the Australian industrial logistics vacancy rate, whilst it's still among the lowest globally, it's increased slightly to 3.2% in Australia. I've also been hearing about Q-commerce from our colleagues in Asia, this phenomenon of ordering a few daily needs, groceries, and having delivered in 10 to 15 minutes.
It's just incredible, Phil. Yeah, look, I saw it firsthand when I was visiting Mum in Mumbai. So, she uses it to order bread, eggs, water, even medicines, just through an app. And then it gets delivered to their apartment in pretty quick time, 10 to 15 minutes. Just fascinating. And it's not a drone, Phil. It's a person coming on a scooter who comes and delivers that stuff.
Yep. Well, I can guess who that's going to be in Australia. It will be interesting to see, whether that does, take off in high density areas in our Australian CBDs. The other thing we're picking up globally in logistics is around older stock. In the US, stock which was built pre-2020 has seen 100 million square feet of negative absorption. That's a very big number. Occupiers are focused on having access to purpose-built warehouses which can accommodate their automation needs and just have access to affordable and sustainable power.
Yeah, I think Phil, just making sure that all forms of real estate, industrial, office, I'd probably even say like shopping centers and residential, are fit for tech-enabled processes will become more and more crucial. Kind of similar to the conversations we've had last couple of years about just a focus on sustainability as well.
Yeah, well, I mean, the pace of change is phenomenal. And Sameer, you and I have talked about some of these various vectors of technology-related disruption in real estate. Well, whether you want to call them disruption or it's evolution, but we've obviously had e-commerce for a long time, but that continues to grow. The impact of AI, autonomous driving, robotics, even GLPs, like the weight loss drugs. I know you've been thinking about this, Sameer. What's a good framework to look at the potential flow-on effects of these technological advancements?
One thing that's of interest, almost every meeting we go into, there's always some client that perks up who's just trialed one of these technologies, whether it's GLPs, autonomous driving, AI. So, we've built up a comprehensive tool now of how some of this technology will impact real estate. For example, if you look at autonomous driving, it should allow you to work whilst commuting in a car. So, this should in turn help with return to work rates. Or, AI can help you build a travel itinerary, right? I just played with that recently. We built up a holiday itinerary by putting it all into AI. So we've taken a look at all these technologies and kind of built out our employment growth forecast, because I think that's where the kind of rubber hits the road, is what does it do to employment? And, we expect white-collar employment will grow at 2.3% per annum from here, so it'll still grow. And the care economy, healthcare, education, etc., the roles will still grow at about 1.3% per annum. And the risk, I think that there's much more greater risk in transport and manufacturing roles, and we've currently sort of penciled in a 5% per annum decline there. So, we've
because of the impact of automation.
Yeah, because of automation, potentially needing less drivers, more robots. And, we've built these models, and now it's just a case of kind of monitoring how things progress against those expectations.
Look, and the most defensive assets will be those that offer tenants best-in-class design and are rich in amenities. And, we've also been saying that consistently, that assets located next to emerging infrastructure, whether it's Melbourne's Westgate Tunnel or Western Sydney Airport or Sydney Metro, they're going to continue to perform well because that infrastructure really does provide the backbone for the movement of people. And by the way, on the retail front, even our US team is saying they expect positive net absorption in 2026, driven by grocery, discount and service retailers. So what are you picking up from our offshore colleagues when it comes to the living sector?
Yeah, Phil, in terms of in Europe, international student enrollments there are expected to grow 5% annually to 2030. I think, these themes about global wealth and aspiration, I think it's just bullish for global international student enrollments. And our US colleagues expect multifamily assets, what we call BTR in Australia. It'll grow sort of low single-digit rent growth and flattish cap rates. For Australia, we've got that same kind of flattish cap rate outlook, but I'm probably a little bit more bullish on the rents. We've got rents at sort of mid-single digit. It's partly because our vacancy is significantly lower, right? It's running at about 1%. So a bit more bullish on the rents.
Yeah. Sameer, let's shift gears a little bit. Let's do a quick walk through what we expect in terms of performance drivers across the major Australian property sectors. So maybe we'll start with industrial.
In industrial, I think that'll be a really interesting sector to watch in 26. Incentives had started to creep up in 25. It took some of the shine away from the sector. But, with this TINA concept, we expect vacancy will peak in first half 26. And then incentives start to come back down in the second half of this year. And that gives you a really good setup for industrial in 27 and 28.
Yep.
Really good rent growth.
That's good. All right. And for office, we've penciled in another 7% net effective rental growth for Sydney's CBD core and Brisbane CBD. So this will take the cumulative rent growth in the Sydney CBD core to 35% and Brisbane to 47% off their low point in 2021. And interestingly, Melbourne should start to accelerate towards mid to high single digit growth from 27 onwards.
Yeah, Phil, I always find it fascinating when you do rent analysis in a cumulative manner. So looking at the last couple of years or the next couple of years, because it just shows you how much rents could accelerate in the next couple of years. For retail, we're expecting the tempo to shift. The last few years was really good for LFR, large format retail. And we think LFR will still do well, but regional shopping centers is where growth will be a little bit better, returns will be a bit higher. So by city, we think rent growth is going to be fastest in Perth for retail.
Yeah. And then lastly for resi, we are expecting supply will stay lower for longer. And I think your team's expecting 3% rent growth in 26 and then 6% and 8% growth in the next 2 years. But as we were chatting before this meeting, you said rent growth could accelerate much more quickly if employment conditions remain healthy, which kind of looks that way at this point.
Yeah, look, I was definitely taken aback last year by how apartment prices moved. We were looking for about a 6% type growth in apartment prices last year, and they grew 8.5%, so did much better. And now, I think rents could track higher much earlier as well. This is all part of our S-curve thesis on residential.
Yeah. All right, let's switch to cap rates for a minute. Sameer, where do you expect to see compression and where do you expect to see rates to stay flat?
Yeah, in shopping centres, Phil, cap rates should compress 5 to 15 bips across Australia. BTR and PBSA will be broadly sort of flattish. I think it'll be flat for most office markets with the exception of Brisbane and Sydney, where there's lots of interest from capital. Get another 10 to 15 bips in those two cities. In logistics, it'll be a more mild 5 to 15 bips cap rate compression with maybe Melbourne staying still flattish.
And then risks. Your call on the biggest risks for the Australian property sector. I'll give you one too.
Yeah, Phil, I still think it's in the property-related taxes. It's hurt the sector last couple of years, and we'll just need to keep a very close eye on it into the state's budget cycle, which is in May, June. And Phil, your thoughts on risk?
Well, I think the construction sector productivity is still a big problem, and it's going to be topical clearly when it comes to new development. So this is it's a lingering challenge that we have to address, with some continued risk. And also I think what tenants and particularly investors really want this year is constructive policy that assists in the supply side and, of course, stable interest rate conditions.
And by the way, Phil, I was thinking back over the last couple of years and, in recent times, we've had one big portfolio deal each year that's just lifted the overall transaction volumes in Australia. Last year was towards the end of the year, big senior living deal with Aveo. In 2024, there was that large data center portfolio transaction with AirTrunk. In 22, it was an office portfolio transaction with Investor. And in 21, it was the logistics portfolio with Cube. I just wonder where we'll see the big trade of 2026. There's always one.
Yeah. Yep. I think there's certainly some scope for some larger ticket sizes in 26. I think that's highly on the cards. All right, so let's bring it all to a close, Sameer. Like the last few years, let's get into some of your predictions for 26. What are your top 3 or 4?
Phil, my first prediction is that we'll see the best total returns in 2026 from office in Brisbane, and then some of the other markets which will be part of the leaderboard include industrial in Adelaide, shopping centres in Sydney, and I'll go with the apartments in Gold Coast. And then my second prediction is that prime assets across all sectors and all cities will start to see some evidence of incentives compressing in the second half of 26. This plays into our kind of TINA thesis. My third prediction is that kind of plays to what you were talking about, construction cost growth will be, I think, at least 5% in the second half this year. And, we will all ask ourselves, why did we not build sooner? And my fourth prediction is that we'll have a couple of large billion-dollar type portfolio transactions in 26. Most likely this will be in the alternative sector, maybe in senior living, maybe healthcare, hospitals, childcare, maybe even in private credit.
Mm-hmm. All right, it's a good list, Sameer. I did note that you didn't have any interest rate predictions in there for this year. I thought we could wager another bottle of wine on that one.
Phil, rates are, it's so hard to call in 26. we're cycling past a lot of noise on electricity, wages. I still continue to believe, though, that our interest rates are too high to allow for any sort of meaningful delivery of real estate supply. So I'd like them much lower than where they're sitting.
I agree with that. All right, well, I think that wraps us up. Thank you, Sameer, and to our listeners. I hope you enjoyed this latest edition of The House View. As always, please send us any questions that you might have via talkingproperty@cbre.com. And make sure to subscribe to Talking Property to ensure you don't miss any of our fortnightly Talking Property episodes. Until next time.